Hey, what's up, everyone? My name is Olive. Welcome back to my world of stocks. Now, we're really just now starting to get that first wave of filings from the SEC being released to the public. It shows what the biggest institutional investors, the rich elites, are buying out there in terms of stocks. And one of the reports that just got released is the one on BlackRock, the largest asset management company in the entire world, being led, of course, by CEO Larry Fink. And it's a company that holds many trillions of dollars of assets. So it's really one of the biggest market movers out there with huge influence over the entire market. So it's always a lot of fun to see what stocks they're buying, what stocks they're selling. Today, we're going to run through the 5 largest purchases that they just made last quarter. This is the most recent information that we have available to us. And I'll give you my own opinion on each one of those purchases. And as always, I'll even rank those stocks from best to worst too, based on that opinion and at today's prices. So let's go ahead and jump into it. By the way, we will also be checking out other famous investors as their reports come out to us too. So please consider subscribing if you don't want to miss out on that content. But with all that said, let's jump into this list here and we'll sort this from smallest to largest position in their portfolio. But I got to say, guys, right off the bat, purchase number 1 was a bit of a shock to me because it was none other than Tesla, ticker symbol TSLA, who, for as popular as they might be to, us smaller retail investors, I actually feel like it's pretty rare to see them make the list of stocks that big investors are buying, the rich elites. In fact, Warren Buffett, for example, has never even considered touching the stock. But here, BlackRock decided to buy another 7.4 million shares, bringing their stake up to over $81 billion worth in the portfolio. Now, the thing about Tesla stock is that it's a pretty wild one. They actually had a rough start to this year, down over 11% year to date so far. So maybe BlackRock will look to continue adding in this new year, given that, it's been falling. However, this is also coming off of a giant surge at the end of last year that still leaves the stock up over 2,000% in just the past decade alone. And in my opinion, the most recent rally had a lot to do with, I would say, 2 primary tailwinds, one being their upcoming launch of robotaxis, and the other being Musk's new friendship really with Trump will likely benefit his companies, help them climb over various regulatory hurdles, what is really likely to be the biggest obstacle for fully autonomous driving and, of course, launching a new robotaxi service, which I believe is desperately needed for Tesla to really justify their giant market cap that is north of $1 trillion, especially given their recent slowdown in growth, with sales actually falling last year. Thankfully, though, Tesla is actively working on multiple growth drivers like energy, logistics, AI, robotics, cheaper vehicles, full self-driving, and of course, that robotaxi service. All things that I do believe will find success over time. AI, for example, we know has really seen a giant surge in demand because of companies wanting to run more efficiently. Well, 3 things that will be very important for that will be energy, autonomy, and even robotics. Tesla themselves are already using the Tesla bot in their factories, and there's no telling how much really free or spare time and even savings autonomous driving will free up for both companies and consumers too. Hence why analysts think that all these different markets, you look at energy, logistics, you have whatever you, whichever one you like, all of them are going to be worth trillions of dollars long term, with Tesla themselves already ahead of much of the competition thanks to how early on they invested in these technologies. In fact, it's estimated that they already collect over 5 million miles of full self-driving every single day, whereas Waymo, for comparison, is only doing a few thousand. Not to mention the millions more of Tesla customers already out on the road doing all the work for them for free, mind you, collecting billions of miles of data that Tesla then uses to train their neural network and algorithms thanks to what is called shadow mode. This is a program that runs in the background of really every Tesla vehicle out there, generating control inputs without actually executing them, to which it then analyzes and compares to the actual maneuvers and actions being done by the human driver, thus helping the entire platform get smarter over time. It's pretty crazy stuff. Now, obviously, we only got a glimpse of this potential at their recent robotaxi event. However, more recently, someone posted on X their trip from the Oakland airport to San Francisco without ever having to touch the steering wheel or pedals, to which Elon responded to by saying that it only gets better from here, as Tesla is on track to launch a robotaxi service in Austin by June, with a bigger rollout to many other cities by the end of this year. Obviously, Musk is known for, over-promising at times, but hey, these are still goals that could be achievable theoretically and would definitely move the needle, I think, for the company and the stock. But overall, I would just say that the pros when looking at that stock are the upcoming innovations, the long-term growth potential, and a close relationship with the president that will really speed up, really help them get over those regulatory hurdles that would otherwise, I think, slow them down by a lot. However, the cons are a very rich valuation coupled with current slowdown in growth, and those are nothing to sneeze at. And because of that, even though Tesla is one of my biggest stocks in my own portfolio, which I'm also up a huge amount on, and I don't plan on selling any of my shares anytime soon, but I'm still going to have to rank them around the middle for now at number 3 until we see what else is on this list, because there are some concerns to be aware of. All right, coming in at purchase number 2, though, is a stock that will absolutely challenge Tesla on our rankings here, and that is the mighty Amazon, ticker symbol AMZN, who BlackRock has been consistently adding to every quarter, with another 21 million more shares added this latest one, bringing the stake up to over $150 billion and worth over 3% of their overall portfolio. By the way, that might not seem like a big increase there. It's only a 3% rise, but that actually equates to over $25 billion. For any regular sized hedge fund or asset manager out there, that would be an unbelievably gigantic purchase. So it just shows you how much power and influence BlackRock can really have over the market. Now, having said that, I not only agree with this purchase, as Amazon is usually a top 5 holding in both my personal portfolio and even our community one too, but it also just makes perfect sense for the world's most dominant asset management company to also want to own the world's largest e-commerce and especially cloud computing company too. And that's probably what I'm most excited about myself, given the importance of artificial intelligence long term, where most companies won't be able to afford, building their own massive data centers with super expensive server racks and computers and all the processors and everything that goes to them, even having access to the energy that is needed to run all of that and so on. You get the idea. But what these companies can do is pay much smaller amounts, smaller fees to Amazon over time to basically rent them out for their own use too, all of which is very high margin for Amazon, which is why they're seeing such incredible growth on the bottom line, where net income nearly doubled in size last year. That's incredible. And yet, as massive as $60 billion of pure profit might seem, it was still nothing compared to the more than $500 billion that they do in revenue, which is still somehow growing at a double-digit rate too. And that right there is the main reason why, even though the stock has soared to an all-time high, I still consider it to be a solid buy for pretty much anyone thinking long-term, because of that massive growth potential on the bottom line. There's just such a discrepancy there, so much room that they can still make up over time once they actually start caring about profits, which is also why their valuation is not even as expensive as you might think when you look at more forward-looking metrics. Their forward PE ratio, by the way, is about 80% cheaper than their 5-year average, and their PEG ratio, price to earnings to growth, is almost the same as the sector, if you can believe it, and that's pretty amazing. So you couple that with the opportunities in AI and everything else that they do, so many things Amazon does, and yeah, they easily get the number 1 ranking from me on this list. Moving on to purchase number 3, though, well, if Amazon is usually a top 5 holding of mine, well, this next one has actually been my number 1 biggest for a while now, and that is the tech giant Microsoft, ticker symbol MSFT, which BlackRock added another 14 million more shares of, bringing the stake up to just shy of $250 billion and worth almost 5% of their entire portfolio. Now, when it comes to Microsoft, what I love the most about them is the unbelievable profitability, which, by the way, they also grow by double-digit rate on both the top and bottom line, just like Amazon, despite their massive size too. Which, speaking of Amazon, by the way, despite Microsoft doing less than half their sales, they actually do over $30 billion more in profit. And that's insane profitability at that scale and the margins that we're talking about here. And it has a lot to do with just how good Microsoft has really become at hooking users onto their platform and then over time charging subscription fees that are very consistent and also very high margin for them. Something that really nobody, in my opinion, does a better job of than Microsoft. When you look at Windows, Office, LinkedIn, GitHub, there's gaming, and of course Azure, and even AI now with Copilot and so many other things too. But really AI, well, that's where most of the growth is going to be coming from long term, as Azure is already the second largest cloud provider that still manages to grow consistently by over 20% each quarter with margins above 70% too. And I expect that to easily continue long term given the rise in AI demand, which Microsoft is going all in on, promising to invest now another $80 billion on AI enabled data centers this year alone, something that only a massively profitable company like Microsoft could ever really dream of being able to afford, right? Only they could really afford that. And a couple of, Amazon, Google, those types of companies. Of course, though, like Amazon, the stock has also been an incredible performer over the years, meaning you're not going to find a cheap valuation here either. But in terms of ranking them, well, I'd say that they're just about tied with Amazon. And I don't see any reason why any long-term minded investor shouldn't hold both stocks in their portfolio. I do. But that's just me. Anyway, because I do have to give you some kind of ranking here, I suppose I'll give the very slight edge to Amazon just for having a market cap that is over $500 billion lower than Microsoft's, where I just see perhaps a little more upside potential too, given the larger room for growth on the bottom line when you look at the discrepancy there for Amazon profits to sales. Okay, having said that though, purchase number 4 does actually have the possibility of dethroning either company really from our rankings, as we have the ultra popular AI juggernaut NVIDIA, ticker symbol NVDA, who BlackRock added another 38 million more shares of, bringing the stake up to over $250 billion and worth more than 5% of the overall portfolio. And yeah, if there's one common theme that we've been seeing so far from BlackRock in this video, it's that they are investing very heavily into artificial intelligence stocks this year because they're probably looking at it as something that is likely to explode longer term. So they want to get in now as much as they can. Well, what a better play on that than, a company like NVIDIA, a hardware and even software specialist that is setting themselves up to really benefit from virtually all areas of AI investment. For example, one of their new servers combining Blackwell GPUs and their Grace CPUs showed a performance increase of 30 times greater than the previous generation Hopper, while still managing to consume 25 times less energy as well. Both metrics being, of course, super important for AI development. You want power, you also want efficiency. Well, Japan, for example, is using them to create their most powerful supercomputer yet, which is also backed by SoftBank, who is a leading partner on Trump's new $500 billion Stargate project that will create giant, massive data centers using millions of NVIDIA processors. It's pretty crazy. And their upcoming Rubin chips may impress even further. They're looking to build those on an even smaller 3-nanometer process and with upgraded HBM4 memory, together boosting performance while still managing to lower its energy use as well. Meanwhile, their software also continues to be a game changer with AI-driven platforms like the Omniverse, NVIDIA Drive, Metropolis, and more, alongside their new AI agents and blueprints that not only help companies automate tasks, huge for the future, but even help them build their own AI agents too, all running on NVIDIA's software and hardware for that optimal performance, all of which has helped both their sales and profits skyrocket, with revenues growing by more than 18 times larger since the pandemic. It's insane. On top of incredible margins, consistently hovering north of 70%, making them one of the most profitable chip companies in the world too. Hence why the valuation is actually cheaper than the sector on a PEG ratio basis by over 30%. How is that even possible? It's really because of their incredible growth on the bottom line. Well, despite the stock soaring by over 1,800% in just the past 5 years, that valuation is actually still pretty attractive. Now, it's honestly a stock that could be tied with Microsoft and Amazon, I would say, when you look at how incredibly successful they've become. However, with a market cap now north of $3 trillion, I know it can be a hard pill to swallow. It's really only sitting behind Apple as the richest company in the world. So, I don't know. I just think maybe you give a slight edge here to Amazon and Microsoft for that little bit safer of a price level in terms of market cap, at least. But also because I just feel those companies are more diversified. So it does make them a little safer, larger, more diversified. But Nvidia is no slouch either. I love all three of them. And Nvidia is actually my second largest stock in my personal portfolio, too. But like I said, I will put them just behind those other two. Finally, though, this leaves us with the last purchase of the list, the largest position of all for BlackRock, and that is in Apple, ticker symbol AAPL, adding another nearly 30 million more shares and bringing the stake up to over $280 billion, worth 5.7% of the overall portfolio. Now, guys, I'll make this short and sweet because, my feelings on Apple stock have been made pretty well known at this point. But that's that. I love the business. I think the ecosystem of products and services is very sticky. And I even see some long-term growth potential with integrating AI into that entire ecosystem, making them more attractive for upgrades and new subscriptions, which they're also planning to do, by the way, in China now through a partnership with Alibaba, where Alibaba is basically going to integrate their AI into iPhones. And that's something that could actually help boost their struggling sales in that very important region. Plus, I also think that iPhone sales could get a little bit of a boost as well from the upcoming foldable line whenever they do decide to release them. But that's just something that I think, could convince some longtime users that are bored or tired of the same old iPhones being released year after year. Releasing a folding iPhone, I think could actually be pretty popular. I have a folding phone myself. It's an Android one, but I love using it. And I think an Apple alternative could perform well. It'll be fresh and exciting and new for customers. But even beyond that, guys, I also see plenty of areas that they could invest their gigantic pile of cash for new out-of-the-box opportunities that we may not even be aware of yet. However, the valuation is just way too rich to get me excited here, which is a feeling that I don't share alone, as even the great Warren Buffett, one of Apple's biggest bulls over the years, has now been selling out of the stock at an incredibly alarming rate. That's not to say that Apple is all of a sudden a bad stock to own. I still think that they'll have pretty good long-term success, hence why I own a small piece of it myself too. But with the price as high as it is, with a market cap north of $3.6 trillion, making them not only the largest in the world, but also they're ahead of other stocks that I happen to like much more, like Nvidia, Microsoft, Amazon, Google, and Meta, some of which Apple eclipses them by over $1 trillion. Well, that's just too rich for my blood, considering the volatile financial performance that can sometimes be stagnant or even in decline depending on the season. So it's not a stock that I'd be too excited about at these levels. Again, it is a stock that I own myself, and I do plan to continue holding it. And overall, I do like what they're doing. But on this list in particular, it's unfortunately going to have to go in last place for me, as I just see more opportunities with these other names. Really speaks to how strong of a list this is, though. And while they may not be the most exciting stocks here, maybe kind of high risk options that people love to speculate on, these are pretty safe, well-rounded, diversified investments here in technology, granted, but some of the best, really the best ones in there. And I think you'd have a tough time just finding any flaws in most of these companies here. So I like the list myself. And of course, I own each of these stocks too. But hey, I'd love to hear what you all have to say down below. What do you think about these stocks? Do you not like them? What stocks are you considering buying? Yeah, I'd love to hear your thoughts. But thanks again for stopping by, my friends. I hope you enjoyed the video. I hope you're all doing well out there. And I will catch you in the next one. All right, take care, everybody. Bye-bye.